Hello, my dear future Chad accountants. This is Chinmaya Hegde, your learning partner for CA Final, FR, and SFM. I hope my voice audible and the PPT is visible. So these are FR upgraded classes. These are not a substitute for either regular class or for crash course class. These are the problems which are solved by the ICI in the new study material applicable from May 21 onwards, and in the materials such as RTP, MTP, and previous years suggested answers. The material for these compilation of questions is available in my Telegram channel, link for which is available in the description. Make sure you have the material available to listen to these videos. We have finished till Ind AS 109, financial instruments. Now let's move on in the order in which ICI has given the standard coverage, starting from Ind AS 115, revenue from contract with customers. Let's go for it. Contractor P enters into manufacturing to contract to produce 100 specialized CCTV cameras for customer Q for a fixed price of rupees 1000 per sensor. Customer Q can cancel the contract without penalty after receiving 10 CCTV cameras. Specify the contract units. Okay. So basically, there are 5 steps in revenue from contract with customers. First step is identifying the contract. And in that, we want to understand what is the contract period. The contract period where parties have rights and obligations. If either of the party can cancel the contract unilaterally without taking others' permission or without paying any penalty, in that case, only up to that period we will consider the contract. For example, illustrations are there. If you have a gym membership for 12 months, but after 6 months, you can cancel the contract without paying anything additional. That means the first 6 months only becomes the contract period. Similarly, in this problem, initial contract is for 100 specialized CCTVs, but the customer Q can cancel the contract without paying any penalty, means unilateral decision can be taken after installing just 10 CCTV cameras. Therefore, only first 10 will be considered. Let's see what institute has given in the solution. P determined that because there is no substantive compensation amount payable by Q on termination of the contract, no termination penalty is the contract. It is akin to a contract to produce 10 CCTV cameras, gives customer Q an option to purchase an additional 90 CCTV cameras. Hence, the initial contract is only for 10 units. I hope you got the point. Let's move further. Software company S enters into contract to license its customer relationship management software to customer B. 3 days later, in a separate contract, S agrees to provide consulting services to significantly customize the licensed software to function in B's IT environment. B is unable to use the software until customization services are complete. Would these contracts be combined? The contract might be entered at different time points, but if they satisfy certain conditions, even though they are different contracts, they are combined for the purpose of Ind AS 115. In which situations they are combined. Let me just give you the quick uh, revision of the charts. You can see conditions for combining. If it is taken as a package for a single commercial objective, it might be different contracts, but objective is one single commercial package. Prices are linked. The contract revenue of one is dependent on another, like some discount you got, some sort of connection. And single performance condition. Though the contract is entered separately, they satisfy definition of one single performance condition. Now in this case, does it satisfy? Okay. You can look at this. 3 days later, in a separate contract, S agrees to provide consulting services to a significantly customized license software. So initially, it was licensed to his customer relationship management software to B, and 3 days later, again they entered into a customized license software, and B is not able to use software until customization is complete. So the customer relationship management software is now dependent or part of same performance obligation along with customized license software, because without customization services they cannot use the product. So they cannot be used independently. So they are part of same performance obligation. Let's see what institute says. S determines that two contracts should be combined because they were entered into nearly the same time with the same customer, and the goods or services in the contract are a single performance obligation. This is the keyword. They are part of single performance obligation. Manufacturer M enters into contract to manufacture and sell cyber security system to government related entity P. 1 week later, in a separate contract, M enters into a contract to sell the same system to government related entity Q. So, entity M is selling into entity P also and selling into entity Q also, and both entities are controlled by such government, same government. During negotiation, M, the seller, agrees to sell the systems at a deep discount if both P and Q purchases the security system, should these contract be combined or separately accounted. Three conditions would be there to combine the contract. One of the condition is if the price are linked between the two contracts. Now you can see here, M agrees to sell the system at a deep discount if both P and Q purchases the security system. So which means, what do you understand? The price of one contract is dependent on another contract. When the prices are connected, the two contracts should be combined. So it's a part of single commercial package, and price also dependent. So we can say that contract should be combined. Out of three conditions, even one condition is sufficient to combine the contracts. Okay, let's move further. Telco T Limited enters into 2-year contract for internet service with customer C. C also buys a modem and a router from T Limited. So at this point in time, there are three things, that is internet service, modem and a router, and obtains the title to the equipment. T Limited does not require customer to purchase its modem and routers and will provide internet to customers using other equipment that is compatible with T Limited's network. So when T Limited is providing internet services like Airtel Limited, Geo and all, in this example, they are telling you don't have to use our own modem, you don't have to use our own routers. Customers can purchase from us, but we don't restrict that you have to use our products only. There is a secondary market in which modems and routers can be bought or sold for amount greater than scrap value. Determine how many performance obligations the entity T have. Uh, Let us quickly look at the performance obligations criteria. Just 1 second. I'll just put up the graph. Yes. So performance obligation, if you want to call it a separate, is a good or service that is distinct. So the word is it is distinct. Then it is performance obligation or a series of distinct goods and services. We are not talking about series of distinct goods and services. We are talking about goods are distinct or not. Okay. For that purpose, what is the definition of distinct performance obligation? Let's look at the chart. Distinct means the customer can benefit on its own or readily available resources. Goods or service can be sold separately. A customer can benefit more than scrap value or customer has already obtained it. So in this condition, what do you understand, my dear friends? The modem and the router, which is definitely required for you to use the internet services. Are there any conditions that you have to use the routers and modem from this company only? Not there. And can customer benefit on its own? The answer is yes. Why? They can sell it in the secondary market and not at a value of scrap value. They can get really the sale price, reasonable price at least, not a scrap value. Which means I think it satisfies the condition of distinct goods and services because it is a customer can benefit on its own and customers already obtained it. He can obtain from some other services also. So I think internet service is one, performance obligation, router and modem, these three I would like to say, three performance obligation. So let me just see what institute has told. T Limited concludes that modem and router are each distinct and the management includes three performance obligations. Modem is one, router is one, internet service is one. Which means modem and router, you can recognize the revenue immediately, but internet service, over a period of time, revenue should be recognized. Based on the following criteria, capable of being distinct, you can read through it, what I told you, and distinct within the context of contract because again T Limited does not provide significant integration service. That's also a point to be kept in mind. Uh, that is, if the company says you have to use our modem only, that means they have to be used together. They cannot be used independently, which means they are part of single performance obligation. But here, these modem and routers can be used separately and not only from these companies' products, and therefore uh, you can say that these are all distinct performance obligations. Let's move on. We Limited grants customer C a 3-year license for antivirus software. You must have many things like Norton, Kaspersky and all. Under the contract, We Limited provides promises to customer C with when and if available updates to that software during the license period. The updates are critical to continuous use of antivirus software. Determine how many performance obligation does entity have. Now the updates are not promised specifically in the sense whatever update comes will be given to them. So the updates are not clearly defined that these are the updates, and with the updates additional benefit what you can get, and they're not told without these updates also you can run. So these are called, we can say that you have from customer point of view, the benefit is received together. That is to say, integration of services are required. Updates cannot be used on its own, and without updates, the license also cannot be used. So they are dependent, they are integrated. So we should say that they are part of single performance obligation. Let's see what Institute has told. We Limited concludes the license and updates both are capable of being distinct. Oh, capable of being distinct. Okay, they're distinct, fine, because the antivirus software can still deliver. Huh. Yes, they said it is critical, but they can still be used only the software. Are they telling different answer here? Antivirus software can still deliver the original functionality during the license period without updates. C Limited also can benefit from the update together with the license transferred when the contract is signed. However, We Limited concludes that license and updates are not separately identifiable because software and services are inputs to a combined item contract. That is nature of We Limited promise to provide continuous antivirus protection for the term of contract. Therefore, We Limited accounts our license and update as a single performance obligation. So initially it looks like they are deviating from our answer, and at the end it basically says it is part of single performance obligation. Let's move on. Just give me 1 second. I'll just restream it. I'll just close it and open it once more. Just give me 1 minute. Okay. I hope now the next question is visible. Let's read. Media Company Limited offers magazine subscriptions to customers. When customers subscribe, they receive a printed copy of the magazine each month and access to the magazine's online content. Determine how many performance obligation does the entity have. They offers magazine subscription. When the customer subscribe, they receive a printed copy of the magazine each month and access to the magazine's online content. So you have a magazine which is ultimately the one performance obligation, and every month. So it's basically satisfies the condition of a series of distinct goods and services. Each magazine is separate, right? Every month is separate. So every month, different magazine comes, but it substantially involves same kind of service. Like every month, you get a printed copy. There is no other separate thing. So every month The type of service you receive is similar, though they're distinct, but the type of service you receive is similar. So it's a series of distinct goods and services. So let's see what Institute says. P evaluates whether the promise to provide the printed copies and online access are separate. Okay, they're talking about the printed copy and online access. Are they separate or same? Content is, let's see, P determines the management arrangement includes two performance obligations for the following reasons. Printed copies and online access are both of capable of distinct because the customer could use on their own. Now, if you want to classify it as two different performance obligations, one of the condition is the product should be distinct. Yes, the product is distinct because for the products to be distinct, customer should be capable of getting the benefit on its own without the two coming together. So you have a printed copy, you have an online access portal, you can read the printed copy, you get the benefit. You have access to the online portal and you read from there, you get the benefit. Both need not come together, which means they are distinct. The printed copies and online access distinct within the context of the contract because they are different formats, so they not significantly customize or modify each other. Basically, no integration, no dependency. So, for these reasons, it is classified as separate performance obligation, the printed copy and the online access. Software company K Limited enters into contract with reseller D, which then sells the software product to end users. So basically, from K Limited, it goes to D, and from D Limited, it goes to the ultimate users. K Limited has a customary business practice of providing free telecom support to end users. So K Limited provides telecom support service. These outsourcing or these call centers, technical support to end users without involving the reseller. Yes, sometimes when you purchase, let's say, car from the showroom, the technical support service will be taken even for computers. For example, when you purchase this, let's say Apple, the distributor might be somebody, but whenever you have a problem, you call to the manufacturing company directly, right? The original manufacturer. That's a very common practice without involving the reseller, and both the reseller and the customer expect Key Limited to continue this Key Limited to provide this support. Determine how many performance obligation that the entity has. Okay. Now the fact that they provide free telephone support, you should not consider. When you expect from a customer point of view, it is a part of the package. That product usage comes along with the technical support. Now, technical support, is it a distinct performance obligation? Yes, it is capable of being distinct because it's a separate service, and therefore we should say that they are they are two different performance obligations. Let's see what the institute says. In evaluating whether telephone support is a performance obligation, K Limited notes that the promise to provide the telephone support free of charge to end user is considered as a service that meets definition of performance obligation when the control of the software product transfers to D Limited. So when the software is sold, at that point in time itself, the expectation is created that the technical support will be given by K Limited. As a result, K Limited accounts for telephone support as a separate performance obligation in transaction with D. Okay, so let's go next. Car maker Unlimited has a historical practice of offering free maintenance service. Example, oil change, tire rotation for 2 years to end customers, sorry, not to end the customers, to end customers of dealers who buy its vehicles. However, the 2 years free maintenance is not explicitly stated in the contract with dealers, but is typically stated in advertisements for the vehicles. Determine how many performance obligation does the entity have. Now, sale of car is one, and this maintenance service is another. Obviously, there are two distinct performance obligations. The question comes here, because the contract does not mention anything, does it still part of two performance obligation? The answer is yes, because the contract need not be explicit, it may be implicit also. So when you give advertisement, you mention that free service will be given for 2 years. So definitely it's part of the contract and they are distinct. So there are two performance obligations. So maintenance is treated as a separate performance obligation in the sale of vehicle. Revenue from the sale of vehicle is recognized immediately when the control of vehicle is transferred to dealer. Revenue from the maintenance service is recognized separately as and when the maintenance service provided to the retail customer. So it is 1 year, one service, you recognize revenue proportionately. One more year, one more service, recognize the revenue separately. Okay. Entity sells gym membership for rupees 7,500 per year to 100 customers with an option to renew at a discount in second and third year at rupees 6,000 per year. Just give me 1 second. Entity sells gym membership for 7,500 per year to 100 customers with an option to renew discount in second and third year at 6,000. Okay. So first year 7,500, second year you have a discount. You can pay only 6,000 second and third year. Entity estimates annual attrition rates are 50% each year. So 50% of the people will leave. Determine the amount of revenue to be recognized in the first year and amount of contract liability against an option given to the customer for renewing the membership at discount. Okay. Now, what you should do here is this. First, customers coming and you are giving them discount for second year and third year. But the second year discount depends on first year membership, correct? And third year discount depends on first and second year membership. So, these prices, when you allocate, you cannot say first year 7,500, second year 6,000, and third year 6,000. That's not the way. Because performance obligation from the entity side is all the 3 years are connected. So, what you should do for all the 3 years, you estimate the revenue and distribute proportionately over a period of 3 years. So, if I show it in this way, hopefully you understand better. Let's see. Okay. So, performance obligation are 3 years. So, I'll take first year separately, second year separately, third year separately. And what is the transaction price total? Transaction price, what they done? Transaction price. First year, 7,500 per year. Second year, 6,000. And third year, 6,000. Okay. and this is what transaction price. And if I multiplied by number of customers, 7,500 for 100 customers. Next year 100 customer will not come, only 50 customer comes, so multiplied by 50. And next year 50% of the remaining, only 25 customers will come. So if I calculate this, 7,500 into 100, 7,50,000, 6,000 into 50, 6,000 into 50, that is 3 lakh, and 6,000 into 25, 1,50,000. So total 7 lakh 50 plus 1 lakh 59 lakh plus 3, 12 lakh. Okay. Now this 12 lakh should be distributed among the total number of customers. So what is the allocation? And here we are going to get 100 customer, and here we are going to get 50 customer, and here we are going to get 25 customer. This is the proportion, or we know this is going to be the standalone selling price, right? In proportion of SASP. That's what we say. In proportion of SASP, standalone selling price. That is basically, if you come only for first year, it is 100 into 7,500. If you come only for second year, 50 into 7,500. If you come only for third year, 25 into 7,500. You can ignore that 7,500 is common. So it is going to be in the proportion of 100 customer is to 50 customer is to 25 customer that you allocate among 3 years revenue. So you divide in this proportion, 12 lakh into 100 by total 175. So 12 lakh into 100 by 175. 6 lakh 85 714. This is first year revenue. Or you can say 12 lakh by 175 is going to be the per customer basis. Then 12 lakh into 50 by 175. Then 12 lakh into 25 by 175. 3 lakh 42 857. Then 12 lakh into 25 by 175, 1 lakh 71 829, 1 lakh 71 429. So total you can see it should be 12 lakh. Yes, exactly. And this is what is called as allocation of revenue. Okay. Now if you look at the first year, what is the actual revenue received? 7,500 into 100, 7 lakh 50,000. But how much you actually recognizing it as revenue? 6 lakh 85 714. So if you pass the entry, it will be bank account 7 lakh 50,000 to revenue from contract with customers. It will be 6 lakh 85 714, and balance is an advance. That's what we say, contractual liability. Contractual liability. 64,286. If you tell from customer point of view, that is this is 7,500 per customer. That is what is divided by 100 you can do. And this also if you divide by 100, this is going to be 642.86 per customer will be the advance. Like what Institute has told, collected 7,500 revenue, recognize 6857. Yes, 6857 you can see 6857 per customer. For the year 6,85,714, and the remaining 643, remaining 643, yeah, 640 remaining 643 should be recognized as a contractual liability with the option given to the customer for renewing their membership discount. So next year, when they renew the discount, this amount will actually be recognized as revenue. I hope you got the point. Let me go further. Or if you want me to show the second year also, let me just quickly show it to you how the entry will take place. This is first year. Second year, how the entry will take place. How much amount you received? 3 lakh. So bank accounts, 3 lakh. But how much revenue you should recognize? 3 lakh 42,857. So you write 2 revenue, 3 lakh 42,857. But 42,857 you are not received, which you adjust it from the contractual liability. So you debit contractual liability 42,857. That is second year. Third year, what you are going to do? Bank account, you debit 1,50,000. That's what you receive. 2. Revenue from contract with customers. This number allocated amount 1,71,429. And then balancing figure you adjust against the advance already received, actually contractual liability difference amount 21,429. And you look at this contractual liability 21,429 plus 0.2857. See how much it comes to? 21,429 plus 0.2857, that comes to 64,286. So it was created first year, debited against next 2 years. Therefore, it is adjusted, it is set off completely, which will not be there at the end of third year. And by the end of third year, you would have recognized revenue of 12 lakh. You understand? If you not apply this standard, you would have recognized 12 lakh over 3 years. Now also you recognized over 12 lakh, over 3 years. But the difference is how much you recognize in the first year, how much in the second year, how much in the third year, so that it reflects the true satisfaction of performance obligation. So overall 3 year it remains same, but what is appropriate is what considered here. Anyway, let's go further. Company D Limited provides advertising services to customers. The company D Limited provides advertising service to customers. D Limited enters into subcontract with multinational online video sharing company. F Limited under the subcontract places all of D Limited's customers' advertisements. D Limited's note the following. Okay, so basically D Limited provides the advertising service to customers and it provides subcontract to F Limited, and F Limited places all D Limited's customers advertisements. Okay, so F Limited is a subcontractor here. D Limited is like an intermediary. Customer, D Limited and F Limited. D Limited is intermediary, F Limited subcontract, and then customer who wants advertising services. D Limited notes the following. D Limited works entirely with customers to understand their advertising needs before placing the advertisement. Of course, D Limited is the one who is handling the clients directly. D Limited is responsible for ensuring advertisement meets the customer needs for the advertisement placed. Yes, D Limited is the one dealing with the customer. D Limited directs F Limited over the advertisement to place and when to place it. It's like F Limited is like an employee now. D Limited gets the order and don't give it to them. D Limited gets the order, understand the requirement, and then place the order with the F Limited. Ultimately, D Limited is responsible. D Limited does not bear any inventory risk because there is no minimum purchase required from F Limited. Okay. Uh, Delimited does not have discretion in settling the prices because fees are charged both on F Limited's scheduled rates. Delimited is principal or agent. Now, just because delimited comes in between, you should not say delimited is a principal, delimited is an agent. No, intermediary does not mean they are agents. The question comes the responsibility part of it. Who takes the risk? Who takes the responsibility? And who is ultimately liable? See, if the advertisement is not good, or who is responsible to deliver the goods? Can delimited say, I've connected you both, you handle individually? No, right? Delimited assumes the responsibility. Delimited is liable to deliver the goods, to deliver the services as per discussion with the customer. And delimited gives a subcontract to F limited. That is the convenience of delimited. Customer is no way bothered about it. So if limited some if some advertisement has some uh, unpolitical or some disgraceful content, some some content which is not which you know that it is some religious sentiments being affected, or some it's against all the national integrity of India. So if some obscene content is there, who will be responsible? Delimited, right? Delimited then can take a response, then take a delimited is primarily responsible for customer, and then they can take the claim back from F limited for any damages, but that is a subsequent event. Primarily, who is responsible to deliver the services? It is delimited. So obviously delimited is a principal. Let's see what the institute says. Delimited is primarily responsible, that is the word, primarily responsible for fulfilling the promise to provide advertising services. Although F Limited delivers the placement service, Delimited directly works with customer to ensure that the services are performed to their requirements. Even though Delimited does not bear any inventory risk and does not have discretion in settling the price, it controls it. Yeah, it that's the word. It controls the service before they are provided to customer. Therefore, delimited is a principal and not an agent. Okay, I'll go further. Next. Okay. An entity manufactures and sells computers that includes assurance type warranty for first 90 days. Warranty services 90 days. Entity offers an optional extended coverage plan with which it will repair or replace any defective part for the 3 years from the expiration of assurance type of warranty. Typically, you will provide 90 days, but if you want, you will get an additional 3 years coverage of warranty. Optional, huh? Optional. Since the optional extended coverage plan is sold separately, it is sold separately also. If you want only this, that is also given. Entity determines that the 3 years extended coverage represents separate performance obligation, which is completely fine. The total transaction price for the sale of computer and extended warranty is 36,000. The entity determines that the standalone selling price of the computer and the extended warranties are 32,000 and 4,000. The inventory value of the computer is 14,400. Furthermore, entry determines that based on experience, it will incur 2,000 in cost to repair the defects that arise. 90 days coverage for the assurance type of warranty. Pass necessary journal entries. Okay. Journal entries, straightforward. Let me just show you the entry what they have given. Okay. So basically, we are having uh, yeah two types of warranty here. That is first 90-day warranty and next 3 years warranty. But first 90-day warranty is not a revenue separately because it is part of the original contract. But suppose definitely it's a performance obligation separately. And 3 years performance obligations also is to be recognized separately. So what you are going to do? You have sold goods worth how much? 36,000. And what does 36,000 includes? It includes selling price of the computer 32,000 and extended warranty 4,000. So first journal entry will be bank account debit 36,000 or trade receivables. We don't know whether we receive the amount today or not. Cash or debtors. Account debit 36,000. To revenue 32,000. To warranty 3 years warranty 4,000. Simple. Bank account debit 36,000. To revenue sale of computer 32,000. To warranty obligation which may come later, revenue will be recognized later 4,000 over a period of 3 years. Closed. Then the inventory value, what will you do? Normally, it will go to cost of goods sold. We don't pass journal entry now separately because everything we transfer it to trading account. Effectively, opening stock, closing stock, purchases, everything goes to cost of goods sold. Sale minus cost of goods sold becomes profit. So what will happen to this inventory? 14,400. You should transfer it to from the inventory to cost of goods sold. So cost of goods sold account debit to inventory. Effectively trading account. This is transferred to trading account, means cost of goods sold. And then based on experience, it will require 2,000 in the cost to repair the defects that arise within 90-day coverage period. So for this, we recognize as per Ind AS 37 an expense also separately, liability also separately. So what journal entry will look like? Take a look at this. 36,000 as I told you, cash account or trade receivable accounts. Okay, so cash account or trade receivable accounts 36,000. Then 4,000 is a contractual liability, which is 3-year extended warranty, services type warranty. Recognized revenue not immediately over a period of 3 years. Okay, 1 second. Okay, then we have this 32,000 revenue from sale of computers recognized immediately. Then regarding the assurance type warranty, which is default in sale of computers 90 days, you recognize liability as per Ind AS 37. You recognize liability based on your experience. So 2000 warranty expense you recognize now, expected, okay? This is an estimated cost, okay, based on past experience. And you recognize liability of 2000. Now, one more entry that I told you, cost of goods sold to inventory 14,400. Inventory de-recognized, cost of goods sold recognized. I hope you are able to get this point, my dear friend. Two types of warranty: assurance type warranty, which is default, and service type warranty, which is optional. Now, assurance type warranty, which is part of the revenue 32,000, we recognize a separate liability and recognize a separate expense. Whereas service type of warranty is extended, apportioned over a period of actual warranty period, in this case over a period of 3 years. Now what will happen to this 2000 warranty expense? They're not asked, but I'll just tell you for your reference. Three things can take place. One, you incur exactly 2000 rupees. What do you do in that case? Warranty expense is done, you transfer that to P&L. Warranty liability 2000, warranty liability to bank 2000. That is, everything happened as per expectation. Second thing can happen, you did not incur this warranty. No repair, no replacement, no cost incurred. So what will happen? Reverse this entry. A liability account debit, warranty liability account debit, this accrued warranty cost account debit, and the warranty expense credit. So this 2000 will get offset, expense will get closed, liability will get closed. Third thing can happen, you incur more cost. Okay, suppose you incur 2500. Then what entry you are going to pass? Warranty cost liability account debit to 2000. Additional expense to warranty expense account debit to 500 to bank 2500. So how much warranty expense you have now? 2500. That is transferred to P&L account. Similarly, if it is less also, the liability and expense account will get adjusted accordingly. I hope you got the point, and that's what they have explained here. You can read through that later. Okay, let me go further. Entity sells 100 ultra life batteries for rupees 2000 each and provides the customer 5-year guarantee that batteries will withstand elements and continue to perform to specifications. Assurance type of warranty is expense recognized, liability recognized as per Ind AS 37. Optional, extended warranty kind of thing, it's considered as a separate performance obligation. The entity which normally provides 1-year guarantee to customer purchasing ultra life batteries determine that years 2 through 5%, 5 represent separate performance obligation. Okay, let's read this once more. Entity sells 100 ultralight batteries for rupees 2000 each and provides customer 5-year guarantee that the batteries will withstand elements and continue to perform to its specifications. Entity which normally provides 1-year guarantee, but here how many years? It's providing 5 years. Look at institute, very smart. They are not using the words 5, they are not representing numbers. They are giving the words so that in exam it's not easily readable. You will forget easily. Normally provides 1-year guarantee to customer purchasing ultra life batteries, determines that year 2 through year 5. So basically 1 to 5. 1 year is over, remaining 2 to 5. After 1 year till 5 year represents a separate performance obligation. Then it determines that 1,70,000 and 2 lakh transaction price should be allocated to the batteries and 30,000 to service contract based on estimated standalone selling price and a relative selling price allocation. Entities normal 1 year warranty cost is rupees 1 per battery. Pass necessary entries. So basically, there are two types of warranty. Uh, One is assurance type, other is service type. Now in this case, 1 year is assurance type. Assurance type, revenue, expense recognized separately, warranty expense recognized separately, and liability is recognized separately as per Ind AS 37. Assurance type, that is not a performance obligation separately. But service type, an extended service, optional extended warranty is a separate performance obligation and revenue is recognized separately on that. So in this case, they said 2 lakh is the transaction price. Okay, 2 lakh is the amount receivable or received cash or credit sales. And out of 2 lakh, 1,70,000 should be allocated to the batteries. Yes, 1,70,000 is revenue. Balance 30,000 to the service warranty. That is year 2 to year 5. Contractual liability, service warranty. And with respect to assurance type, an expense recognized based on the past experience, a liability is created as per Ind AS 37, that is 1 per battery. And how many batteries? 100. I think it's not 1. 1 into 100 means 100 will become. And 2000 into, I think it should be 100 per battery. I think this should be a printing mistake. Please make it as 100 per warranty. This should be 100 per battery. So 100 into 100, it becomes 10,000. So warranty expense to accrued warranty cost 10,000. That should be a typing mistake. Please correct it. Should be rupees 100 per battery. Okay. So warranty expense account debit to accrued warranty cost. Now what could happen later? If you incur this exact expense, the liability account debit to bank 10,000 closed, or if you don't spend this money, the entry will be reversed. Or if you spend more money, the extra expense will be paid and extra expense will be transferred to the P&L account. And this amount 30,000 is recognized for year 2 to 5. So this revenue recognized from year till year 5 on proportionate basis. Okay, let's go further. Production company Y sells television show to television company X. Okay, some thing. Production company Y, like big box, sell it to something like Colors TV, Sony TV, something like Star Plus, something like that. Production company Y sells a television show to television company X. The consideration under the arrangement is fixed amount of rupees 1,000 and 100 advertising slots. Y determines that standalone selling price of the show would be 1,500 based on the market rates. Determine fair value of advertising slots is rupees 600. Determine the transaction price. So what is transaction price going to be? As per the contract, transaction price 1,000 rupees, and then fair value of advertising slots is rupees 600. Therefore, it becomes 1,600, comprising of 1,000 fixed amounts and fair value of advertising slot 600. Two separate performance obligations. Fair value of advertising slots could not be reasonably estimated. Then transaction price would be 1,500. Why would use the standalone selling price of the goods promised for non-cash consideration? Okay, so we are having two types of performance obligation here. One is the fixed amount, other is the advertising slot. Okay. Now fixed amount is 1000 and advertising slot is 600. It would be 1600. But why determines that standalone selling price of the show would be 1500. So if you don't have these two separate things, then it would have been 1500. Now we have what is the fair value of this advertising slots? Okay, so how much should be recognized is the question here. Just give me 1 second. Okay, let me just show you slightly differently here. Okay, so company Y, there is one company Y and there is one company X. Who is the seller here? Company Y is the seller. Sale of television show. And what company Y is getting back? They're getting back for a cash and advertisement slot. Cash and advertisement slot. So this is a case of barter transaction, you can say, because company Y is selling a show, a product, and they are getting advertisement slot, a service. So cash is fixed thousands, and slot they are having a fair value. These services should be valued on fair value basis. Basically, barter transaction you can say should be valued on fair value basis. So what is the fair value of the advertisement slot? 600. Therefore, you have to value the transaction price. From company Y point of view, the consideration receivable as total 600. If this fair value was not determinable, if fair value not determinable, in that case, what would you do? Then what do you do? What would be the value of the show alone? That's what they said. Standalone selling price of the show would be 1500. That case, you would have taken 1500 totally, and this advertisement slot would be balancing figure 500. That is when, not now, only when the fair value was not determinable. Here, fair value determinable, you can go for this 1000 plus 600, 1600. Okay, so hope you got this point. I'll go further. Next, customer C is in middle of 2-year contract with Telco Limited. Is in the middle of a 2-year contract. Its current wireless service provider and would be required to pay an early termination penalty if terminate contract today. So if you want to go away today, you have to pay penalty. If C cancels the existing contract B Limited and signs a 2-year contract with Telco D Limited for 800 per month, D Limited promises its contract inception to give a C a one-time credit referred to as port-in credit. Basically, you come to me, I'll give you some amount, any penalty you can pay to them. That's what they say, port-in credit. The amount of port-in credit does not depend on the volume of service subsequently purchased by C during the 2-year contracts. Okay. C is in middle of contract. That you worry about it later. Let's look at this transaction by graph. Customer C to a telco B limited, but we'll forget about telco B limited. Let's focus on telco D limited, who is a new service provider. Contract with telco D limited. Telco D limited, who provides the internet service, wireless service, who provides the service. And what does customer C have to pay? 800 per month. And D limited promises at the contract inception to give C one time a credit of rupees 2000, 14 credits. Now, D limited to customer C is giving one time 14 credit. 14 credit. Okay. Giving credit means it's as good as making a payment, right? Giving a credit of 800 rupees. Okay. Making a payment. It's like making a payment. Okay. For that payment, what service the telecom delimited is getting? Nothing, right? There is no separate service that delimited is getting, and no separate service or no separate obligation from customer C point of view. So this is a typical case of consideration payable to customer, and because no performance obligation, delimited not getting any separate performance obligation, it should be adjusted against the revenue. So 2000, not 800, 2000 rupees. 2000 rupees. This should be adjusted because no performance obligation. So how much will be? They have given. This is for how many months? 800 per month for a 2-year contract. So 800 per month into 2 years, 12 months per year, 24 months. You get 17,200. No, how much you get? 800 into 2 into 12. 19,200 is the revenue, and from 19,200, this 2,000 you subtract. So actual revenue to be recognized only 17,200 over a period of 2 years. Delimited will recognize reduction in the transaction price as promised. Goods are transferred. So per month, if you want to say 17,200 divided by 24. 716. So basically, this 2000 is spread across 24 months, 83.33. So 800 minus 83.33, you get 716 something. Same number you get. Yeah, same number you get. So basically, this contract one-time credit given is consideration payable to customer spread across 24 months subtracted from revenue. I hope you got the point. Next, Telco G Limited grants one-time credit of rupees 50 to a customer in a month of 14 of 2-year contract. In month 14, okay, in sometime during the middle of the month, rupees 50 one-time credit. The credit is discretionary and granted as a commercial gesture, not in response to prior service issues, often referred as retention credit. The contract includes subsidized handset and voice data plan, G Limited does not regularly provide these credits and therefore customer do not expect them to be granted. How will this be accounted under Ind AS 115? Okay, now the credit does not relates to satisfied performance obligation. So they are not told you have to be with us for 3 years, then you get this credit back, right? There is no separate performance obligation and there is no expectation. Customers do not expect them to be granted. It is as a gesture they are given. Recently, I've seen Zerodha has given some 1,000 points credit as a gesture to its initial 1 lakh customers, which they can use the points, they can use it in various ways, something like that, which was not expected to retain the clients or some sort of gestures or some to celebrate some 10-year anniversary, something they have given, does not have any separate performance obligation. The change in, okay, it is accounted therefore as a change in transaction price, not a variable consideration, because it was not considered earlier. There was no expectation earlier. There is no performance obligations. So it's a change in transaction price, not a variable consideration. The change in transaction price resulting from credit is accounted as a contract modification and recognized over the remaining term of the contract. If in this example, rather than providing one-time credit, G Limited granted a discount of 5 per month for remaining contract term. Also, G Limited would conclude that if it was a change in transaction price, it would apply the contract modification guidance and recognize the credit over the remaining term of the contract. So contract modification terms would apply. What is contract modification terms? If you remember, you can have. Is it a separate performance obligation? It is not. Then it's part of same consideration. It's part of same performance obligation. Then you revise your revenue on a retrospective basis, cumulative catch-up basis. We have discussed in other problems. So this is not a variable consideration. This is part of the existing contract but change in the transaction price recognized over remaining life based on or like a contract modification. Hope you got the points. I'll go further. An entity, a music record label like T Series maybe, licensed a customer a 1975 recording of a classical symphony by a noted orchestra. The customer, a consumer products company, has the right to use the recorded symphony in all commercials, including television, radio, and online advertisement for 2 years in country A. You get the right for 2 years. In exchange of the providing the license, the entity receives fixed consideration of 50,000 per month. The contract does not include any other type of goods or services to be provided by the entity. The contract is non-cancelable. Determine how the revenue will be recognized. Okay. Let me just show you by a graph. I mean, not representation, not graph, diagrammatic representation. Okay. A music record label entity A music record label licensed to customer. Okay. There is one entity, music record label, some entity, let's say, an entity. To a customer, there is one customer. What they have given? Uh, a license to use 1975 recording of classical symphony. So, license to use 1975 recording, long old recording, and customer can use, they have right to use in all commercials, so they can use it in TV, they can use it in radio, online advertisement, they have right to use. Okay, and in this context a question is this, and this is for how many years? Not forever. This is for uh, consideration of 50,000 per month, 2 years. Okay, online advertisement for 2 years in country A. This is for 2 years. This is for 2 years and 50,000 per month. Okay. The question is this: is this contract, sale of revenue from the contract with customer, or revenue from contract with customer, or the goods transferred at a point in time, or over a period of time? What is the performance obligations of the entity? Entity has given the license for the period of 2 years. Now, is it a point in time transfer, or is it a over a period of time transfer? What do you think? Sir, 50,000 per month, no, over a period of time. Don't look at that point of view. Think from the seller point of view. Seller has given the right for 2 years. It is non-cancelable also. Now, does seller has any other obligation with respect to use of these rights? Does this entity has any other obligation? Any other obligation? The answer is no, right? See, if it is a gym service, subscription, every time you go, the equipment should be provided. Newspapers, they have to be newspaper separately. Internet service, cable charges, that is your television, or these kind of things. They have to give you services every month, right? Internet service and all. It has to be continuous service. There is an obligation on the entity side to provide these services continuously. So you pay per month. But here you are given the license. Over. Recording happened long time back. There is no other obligation from entity side. So it is not over a period of time. It is at a point in time. It is at a point in time means entire amount should be recognized immediately. Maybe you can do a present value of it because there is over a period of 2 years. So you can do present value and recognize interest element if it is a significant interest component. That is again separate issue. But revenue should be recognized immediately, not over a period of 2 years, since it is a transfer at a point in time and not over a period of time. The same point is discussed here. You can read through it. I'll also quickly read through with you. The entity assess the goods and service promised in the customer, determine with which goods and service are distinct in accordance with paragraph 27 of NDS 1 and 5. Entity concludes that its only performance obligation is to grant the license. Entity does not have any contractual or implied obligations to change the license recording. The license recording has significant standalone functionality, that is, ability to be played, and therefore ability of the customer to obtain the benefits of the recording is not substantially derived from entity's ongoing activities. No continuous support required. Entity therefore determines that contract does not require and customer does not reasonably expect entity to undertake activities that are significantly affect the license recording, no further activities required. Consequently, entity concludes that nature of its promise in the transferring the license is to provide the customer with the right to use the entity's intellectual property as it exists. Look at this one. As it exists at a point in time. As it exists at a point in time that it is granted. Therefore, the promise to grant the license performance obligation is satisfied at a point in time. Entity recognizes all revenue at a point in time when customer can direct the use of and obtain substantially all of the remaining benefits from the licensed intellectual property. Hope you got the essence of it. Let's go further. Software company X licenses its software application to customer Y. Under the agreement, X will provide updates or upgrades on when, if available basis. Y can choose whether to install them. Y expects X will take no other activities that will change the functionality of the software, determine nature of license. So basic point is it a transfer at a point in time or a transfer over a period of time? Now, license you have got it, but updates, upgradation, when and if available basis, and that too while limited can choose. You have taken tally updates will keep coming. You can use the update, you need not use the update. Updates are not an integral part. If you want, you can do it, which means the updates, we can say a separate performance obligation. The license on a standalone basis is a transfer at a point in time. So, based on the facts given in the question, it can be concluded that although updates and upgrades will change functionally of the software, they are not activities considered to determining the nature of entity's promise in granting the license. Means it can be used independently. Activities of the X Limited to provide updates or upgrades are not considered because they are transfer of a promised goods, that is updates or upgrades that are distinct from the license. So that is separate, this is separate. Therefore, the software license provides the right to use IP is satisfied at a point in time, which means for the licensed software, revenue can be recognized immediately. Film Studio C grants license to customer D to show a completed film. C plans to undertake significant marketing activities that it expects will affect box office receipts for the film. The marketing activities will not change the functionality of the film, but they could affect the value, determine nature of license. Just 1 second. Okay. The question is this: license given. For example, a film is made, some Shah Rukh Khan movie. Somebody produces and they give it to theaters to project the movie. Completed film. The important word is a completed film. Now, what is the obligation of the seller here? Studio C here. I have given you film. You project it, make money. Give me some money, either percentage of revenue or whatever the case, license. But what Studio C is doing, uh, it will take some marketing activities that will not change the functionality of the film, which means I have given the right of using this film to you. You can project it. Now, for the projection purpose, is there a condition I should market it? No, right? The projection part and the marketing part are not connected. That is, for the benefit of it, you do marketing activities. That will happen in any other products also. For example, lace company, they sell it to distributors, but lace make the advertisement, correct? But when will they recognize revenue? The moment they make a sale to the distributor. The distributor cannot demand you make the advertisement, let the sale happen, then I'll give the money to you. That's not the case, right? They sell it to distributors. Similarly, here the license is given and it's a completed film which is available for use immediately. The marketing activities are a value add on, it's not a performance obligation, and does not affect the functionality of the license. It does not affect the functionality of the right to use from customer point of view. They can use it immediately, available for immediate use. So it's a transfer at a point in time, not over a period of time. Revenue should be recognized immediately. Let's see what institute says. C would probably conclude that the license provides the right to use its IP and therefore is transferred at a point in time. Clear? There is no expectation that C Limited will take undertake activities to change the form or functionality of the film because IP has significant standalone functionality. It can be used separately. IP, intellectual property, license. C's marketing activities do not significantly affect delimited ability to obtain the benefits of the film, nor they affect IP available to delimited. Now, uh, okay. Now just imagine this is not a completed film. If it was an ongoing web series or ongoing television serials, then it would not be at a transfer point in time over a period of time, because the studio has to keep producing this episodes and keep on handing over to television company. Got it? In that case, it would not be point in time, it would be over a period of time. As and when the episodes are given, revenue can be recognized. Hope you got the point. Okay, let's go further. A sports team delimited enters into 3-year agreement to license its team name and logo to apparel maker M. Okay, maybe some Nike comes up with Manchester United on its back, something like that. The license permits M to use the team name and logo on its products, including display products and its advertising or marketing materials. Determine the nature of license in the above case. Modifying the facts. Sports team D does not, I mean, D has not played games in many years, and licensor is a brand collector B, an entity that acquires IP such as old team or brand names and logos from defunct entities or those in financial distress. B's business model is to license the IP, obtain settlement from the entities that use IP without permission, without undertaking any ongoing activities to promote, support the IP. Would answer to different in this situation. Read this problem once more. Okay. Before we reading the answer, let's understand the situation. Okay, a sports team D. Okay, there is sports team D. Sports team D enters into 3-year agreement to license its team name and logo to apparel maker M. Apparel maker M. Okay, so they have given the right to use team name. Uh, and of course, they are going to make the payment. How much we don't know, whatever, they are going to make a payment, and they can use the team name in where display products, advertising, marketing materials. So they can use the team name, right to use in display products, whatever, advertising, marketing materials, brochures, t-shirts, whatever it is. Now the question is this: has sports team D Limited has any other obligation? No, they don't have any other obligation. Of course, you know the question. What we have to answer here, right? Either we have to say it is a point in time or over a period of time. If entity does not have any other obligation, that means it becomes point in time. But one point to be kept in mind: team name, right, is given. But what is the expectation of the apparel maker? What is the expectation? He is making a payment, getting the right to use the team name, but the team name should be there, right? The team should perform. Whether they perform well or not is separate, but they should be there, right? In the existence, they should participate. That is, the expectation is depending on the ongoing activities of sports team D. If they perform well, if RCB keeps winning the games, the T-shirts will sell more. In the sense, maybe they make a more payment. I don't know, but the contract value, or I would at least say that the expectation, contract value, keep it aside. The expectation is the ongoing activities are relevant. That sports team cannot just stop playing, and you can use our team name. We are not playing. That's not the expectation, right? Implicit expectation is ongoing activities of the team will influence the contract. Therefore, it is not a point in time, it is over a period of time. But in second situation, we observe, modifying the facts above, sports team D has not played game in many years. In this case, what would happen? So when apparel goes, know that sports D Limited does not play. So expectation is not to play them over a period of time. Our expectation is just use the brand name. Ongoing activities does not affect. So in that case, we'll conclude it as it's a transfer point in time, not over a period of time. I'll quickly read through the solution. Let's see if we're able to understand. The nature of D's promise in this contract is to provide M with the right to access sports teams IP, and accordingly revenue from license will be recognized over time. Recognized over time. In reaching this conclusion, D Limited considers all of the following facts. M reasonably expects, look at the word M, the apparel manufacturer, M reasonably expects that they're expecting the team to be doing ongoing activities. to continue undertake activities that support and maintain the value of team name and logo by continue to play games and field a competitive team throughout the license period. These activities significantly affect AP's ability to provide the benefits to M because the value of team name and logo is substantially derived from or depend on ongoing activities. They are highly correlated. Activities directly expose M to positive or negative effects, whether D limit with D plays games and fields a competitive and will have a direct effect on how successful M is going to sell the products featuring the team's name and logo. These ongoing activities do not result in transfer of goods or service M as they occur. The team playing games does not transfer goods or service to M. Based on B's customer business practice, the second situation, apparel maker probably does not expect, they're not expecting, they're not playing the games for many years, does not expect undertake any activities to change the form of the IP or to support maintain IP. Therefore, B would probably conclude, again, since I think we need more clarity, so that you can use the words in exam, probably would conclude that nature of its promise is to provide M with the right to use IP as it exists. That is no further activities. You can conclude it's a point in time. It's a point in time, license is granted. Okay, so hope you got the point. I'll go further. An entity G Limited enters into contract with customer P Limited for the sale of machinery of 20 lakh. Simple, straightforward thing, sale of machinery. P Limited intends to use the said machinery to start a food processing unit. Okay, some restaurant maybe. The food processing industry is highly competitive and P Limited has very little experience in the said industry. P Limited pays non-refundable deposit of 1 lakh at inception of the contract and enters into long-term financing arrangement with G Limited for the remaining 95% of the agreed consideration, which it intends to pay primarily from the income received derived from its food processing unit as it lacks any other major source of income. The financial arrangement is provided on a non-recourse basis, which means if P Limited defaults, then G Limited can repossess the machinery but cannot seek further compensation from P Limited, even if the full value of the amount owed is not recovered from machinery. The cost of the machinery of G Limited is rupees 12 lakh. P Limited obtains the control of the machinery at a contract inception. When should G Limited recognize the revenue from sale of machinery to P Limited in accordance with Ind AS 115? Please read the problem once more. We'll discuss afterwards. Okay, let me explain the situation. Okay, entity G. Okay, G Limited is one, other is P Limited. G Limited enters into a contract with P Limited for sale of machinery. So it is sale of machinery. And they'll make a payment consideration of 20 lakhs. It is used to start a food processing unit. Is highly competitive, has little experience. So this is going to be used in food processing, maybe some chips or some packaged foods. Food processing unit. And P Limited is inexperienced and this is highly competitive market. Means lot of players are already there. Highly competitive. P Limited pays non-refundable deposit of 1 lakh at inception. Okay. So out of 20 lakh, 1 lakh is paid at inception. 1 lakh non-refundable at inception. And second case, remaining 95%, right? Remaining 19 lakh. Remaining 19 lakh. Remaining 95%, 19 lakh. Which it tends to pay primarily from the income derived from its food processing unit as it lacks any other major source of income. So P Limited does not have any other source. No other source. So you give me the machinery, I will make the food units, I will sell it, whatever income I get, I will use it for repayment of your machinery. It's as good as you doing your own business. Anyway, so income from the food processing unit does not have any other source of income. Also, it is non-recourse basis, which means G Limited has the right to take the asset back. Non-recourse basis, right to take, right to take the asset back, right to repossess. I'll say, right to repossess, right to repossess, which means if P Limited does not make the remaining payment, they have right to possess the machinery back, and also uh, they cannot ask for any balance payment. Okay, this is the situation whether G Limited can recognize revenue or not. For the purpose of GST, it's a revenue, no doubt about it. But we are coming to Ind AS substance over form. There are many conditions to be satisfied. One of the main condition is the revenue can be recognized provided the receipt is probable. Provided the receipt is probable. Looking at the situation here, you have received only 1 lakh, which is only 5% of the proceeds. 95% is outstanding. P Limited does not have any other source of income. They should use the machinery, produce the products, sell it, get the money, then you pay it to them. Then they will pay it to you. The two, they're inexperienced, newly entered, highly competitive business. So looking at these facts of the case, it is reasonable to conclude that the receipt is not probable. When receipt is not probable, revenue should not be recognized. Whatever the amount received should be taken as advance. Moreover, can this non-refundable deposit, can you take it as revenue? They do so under two conditions. One, substantial amount is received. Second, contract is terminated. Both are not there, so revenue cannot be recognized now under any conditions. Any amount received should be shown as liability. Any amount that you are going to receive also should be shown as liability in the books of G Limited. When will they recognize revenue then? They should keep on reassessing these five characteristics. There are five characteristics for a contract for revenue to be recognized. What are those five conditions? Quickly, parties have approved the contract. You can identify rights and regard rights, payment terms, contract as commercial terms. It is probable. So these conditions should be satisfied. If not satisfied initially, like in this case, revenue should not be recognized, amount received should be recognized as liability. But they have to continuously assess these 5 points in the future whenever those 5 points are satisfied. In this case, whenever there is a confidence that receipt is probable, this liability can be converted into revenues, and balance revenue also outstanding amount and asset can be created. That's what they say. Uh, yes, the same thing is there. You can read through the sentence, this one slide and one more slide. You can read through it. But whatever in substance I've told, they've explained in detail. Hope you got the points. Okay. I think remaining problems on Index 115, remaining 10 around 10 problems are there. We'll take it up tomorrow. Okay, because I'll not be able to complete. Some big problems are also there. So remaining problems, we'll take it tomorrow. We'll meet you tomorrow at same point in time. Till then, take care. Bye bye.